In trading, a lot of success is focusing on doing the right things and weeding out the wrong things. I'm friends with a lot of successful traders. I work with a lot of students that have learned this game, and I've got 3 things that you should steal habits-wise and 3 things that you should avoid. Hey everyone, lead trainer with StocksToTrade, Tim Bohen here. Be sure to like this video, share it with your friends, and ring that bell to be notified as soon as a new video drops. Today we're going to talk about some of the most successful habits as well as detrimental habits that I've learned from day traders out there and successful students. First thing I want you to do is focus on the hot sector of the day. Now this always changes and evolves, but if you're running your scan, if you're reading the news, you're gonna know what's hot right now, and there's always something. It's one of the greatest things about the stock market is it never gets old. You're never looking for an idea. You're never looking for new information. There's always something hot that's moving multiple stocks. We love sympathy plays. It's one of the best ways to trade in the short term with day trading. Look for that big mover that's in a sector, then you can catch that big mover when it follows with the press release or the follow-up news. Dial in on hot sectors. The other thing I want you to do, the bad habit, is avoid last year's hot sector or last quarter's hot sector or 3 years ago hot sector. I mean, simple fact is at the time of this recording, we are 2 years since what I would call real weed stock run, a significant marijuana CBD stock, but I see it every day. There's a marijuana stock up 2% and everybody's like, the big run is coming. We haven't seen it for 2 years now. We've had some big runs in the past, but wait for the sector to present itself. I think this is one of the key takeaways. When there is something truly hot, you'll know. You don't have to be there first. Wait for it to be painfully obvious. That's the best time to focus on the hot sector. Next thing I see so many successful traders do is focus on liquid stocks and vice versa. I see so many struggling, frustrated traders, they're focused on illiquid stocks. Now, we talk about charts. So many of these videos, I'm telling you, look at these patterns, look at this move. Chart patterns repeat. I say look at charts till your eyes bleed. But if there's no volume, there's no significant volume, which in our terms, that's at least 1 million shares a day, at least 1 million shares a day if it's over $1. If it's less than $1, it's got to be higher. And ultimately, the higher the volume, the better. Stock market's about supply and demand. The more demand means more volume. The more potential for a sustained move is driven by more buyers, which translate into volume. So the biggest thing I see successful traders doing is only trading liquid stocks. If you're right or you're wrong, you can get in and out easily no matter your position size. If you're trading some puny illiquid stock, even with a good chart, if it's trading 100,000 shares or 10,000 shares a day, even with a small position, you can't get out without creating slippage. You're basically trading against yourself. So do that. Avoid anything with less than 1 million shares traded, and that will get you out of mediocre or keep you out of mediocre setups, I should say. Third thing is that I see successful traders doing versus unsuccessful is pay yourself first, okay? You're in this game to pay for a vacation, to pay down debt, to maybe just save your money. But the biggest thing is think about trading as a skilled trade, like an electrician, like a plumber, like a surgeon, like a builder. All of these guys, all of these and gals that are in these skilled trades, they're gonna practice their skill, then they're gonna pay themselves first, they're gonna save money or accomplish whatever their other goal is. What I see so many unsuccessful traders do, they have a few wins and they just trade bigger. And they don't take that money out. So now they're going from 100 share positions to 1,000 share positions. They haven't matured as a trader. They've upped their size. They've upped their size before they prove they can be consistent. And when that one trade comes against them, it blows up months or even years of what you worked so hard for. Something I talk about with trading, short-term trading, is treat this as a side hustle, something that can supplement your income. I mean, if you did something, a side project, whether it was a building or a piece of art, if you sold those projects, first thing you would do is take that money and reinvest it in something or pay down debt. In trading, I see the opposite, especially among unsuccessful traders. They just use it to up their size, they get greedy, they make a few hundred, they want to make a few thousand, and it almost always ends up worse. So let me know in the comments. I'd like to know, what's your methodology? I'm not saying one is right or one is wrong, but do you pay yourself or do you just leave that money in your account and up your risk? I would hope you're banking those profits to accomplish your goals with trading. But let me know in the comments below.